In late 1989, Tokyo had a square meter of land in Ginza selling for prices that sounded like a translation error. People were looking at a few square miles around the Imperial Palace and saying, with a straight face, that the dirt under those trees was worth more than the entire real estate value of California. And the wild part is, on paper, that made a lot of ordinary people millionaires, until the paper caught fire. My name is Tom, and I spend way too much time thinking about what net worth actually means, how wealth gets measured, and why smart people keep falling for the same money illusion. If you're someone who's trying to build real wealth without getting hypnotized by headlines, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact accounting trick that makes millionaire stats look way bigger than reality, and how financial institutions and media quietly benefit from you not knowing the difference between paper wealth and usable wealth. And to see why this matters, we have to go back to that Tokyo moment where everyone felt rich, right before they learned what illiquid really means. Look, here's the thing. When people ask how many Americans are millionaires, they think they're asking a simple question. Like it's a head count. Like you could just open a spreadsheet, filter for 1 million, and call it a day. But millionaire is a word with multiple definitions, and almost nobody tells you which one they're using. And that's not a small detail. That's the entire story. Because if you count someone's house, the number explodes. If you don't count the house, the number collapses. And if you don't count the house and you don't count money that's trapped behind retirement rules, the number gets almost uncomfortably small. So when you hear someone say, America is full of millionaires, you should immediately ask, millionaires in what sense? Net worth, investable assets, household or individual, before tax or after selling costs, liquid today or theoretical someday? Now you might be thinking, Tom, come on, a million is a million. No, a million is a measurement, and measurements can be rigged without lying. Let me show you what I mean. There's a very famous number floating around right now from the UBS Global Wealth Report. It puts the United States at roughly 23.8 million millionaires, people with net worth above $1 million. That's an insane number when you first hear it. That's not some tiny club. That's basically a small country. And if you stop there, you walk away thinking, okay, so being a millionaire is common. Maybe it's not even special. Maybe I'm behind. But now you might think, what's inside that net worth number? Because net worth includes everything. Home equity, retirement accounts, business equity, even stuff that costs you money to convert to cash. And this is where it gets really interesting. Capgemini, in its World Wealth Report, uses a different definition for high net worth individuals. Their standard threshold is $1 million in investable assets, and they explicitly exclude the primary residence. They're trying to measure money that can actually be deployed. Stocks, bonds, cash, brokerage accounts, certain investable funds. Not your kitchen, not your roof. Using that definition, the United States has about 7.9 million people who qualify. Read that again in your head. The same country can be described as having around 23.8 million millionaires, or around 7.9 million millionaires, depending on whether you count the home. That's not a rounding error. That's a totally different reality. Now you're asking yourself, okay, which number is the real one? Both are real. But one is useful and one is emotionally seductive. The net worth number is a status number. It's great for headlines. It's great for making people feel either proud or insecure. It's great for selling narratives. The investable assets number is a power number. It tells you how many people can actually move capital, survive shocks, take opportunities, and change their life without asking permission from a bank. And since you clicked this video, you probably care about power, not vibes. So let's answer the question directly with no fluff. How many Americans are millionaires without counting their homes? A clean, defensible estimate based on the investable assets definition used by major wealth reports is roughly 8 million people. Not 24 million, not everybody, roughly 8 million. Now, I'm not saying 8 million is tiny. 8 million is still a stadium filled 100 times over. But it's a very different statement about how rare real financial flexibility actually is. And we can go even deeper because there's another layer almost nobody talks about. A huge chunk of American millionaire wealth is trapped behind retirement rules, trapped behind taxes, trapped behind the fact that selling a house is expensive, slow, and sometimes impossible at the exact moment you need the money. So if what you really mean by millionaire is, I can write a check for $1 million today without changing my life, the true number is lower than most people can emotionally tolerate. Let's zoom in on the mechanics, because the mechanics are what set you free. I want you to imagine two guys, same neighborhood, same age, same job title, same income, same family size. They both say, I'm a millionaire. Guy number one has a house worth $800,000. He owes $400,000 on the mortgage, so he has $400,000 in equity. He's got a 401k with $500,000. He has $50,000 in cash. He has $50,000 in a brokerage account. If you add it up, house equity, $400,000, retirement, $500,000, cash and brokerage, $100,000. That's $1 million net worth. And I'm not mocking him. That is real progress. That's discipline. But now ask the brutal question. How much of that can he deploy? If he's 45, he can't just yank $500,000 out of his 401k without taxes and penalties and turning a future problem into a present disaster. If he tries to access the home equity, he has to borrow against it, which means monthly payments, interest, and the risk of losing the house if life hits him at the wrong time. If he sells the house, he pays transaction costs, agent fees, moving costs, repairs, time, the emotional chaos of uprooting his life. So his million is real, but it's not liquid, it's not flexible, and it doesn't buy him the thing most people secretly want when they say millionaire, which is option value. Now guy number two. He rents or owns a modest place with low equity. He has $1.1 million in a brokerage account plus cash. No consumer debt. He still works. But if he gets laid off, he's annoyed, not terrified. Both guys can say millionaire, but one guy has a balance sheet that looks good. The other guy has a balance sheet that behaves like freedom. This is the core psychological shift most people never make. Net worth is not the same thing as financial independence. Net worth is what you'd have if you sold everything, paid everyone, and walked away. Financial independence is what you have when you don't need to sell your life to pay your bills. And the reason this matters is because counting your house as wealth changes how your brain behaves. It makes you feel safer than you are. It makes you spend in ways you wouldn't spend if that wealth were truly liquid. It makes you take on risk because you feel buffered. And banks love that. More on that later. Now, you might be thinking, okay, but my home equity is real. It's not fake. I agree. It's real. It's just not the same kind of real as a brokerage account. Home equity is like having a full pantry. It can keep you alive. It's valuable. But it can't pay your credit card bill unless you sell the food, and the second you try to sell it fast, you realize the buyer gets to set the price. Liquidity has a premium, and people ignore that premium until they're forced to learn it. Let's put real numbers on how common these different millionaires are. First, households. According to census-based household counts published through Fred, the United States had about 134.8 million households in 2025. If you use the Federal Reserve Survey of Consumer Finances and you count net worth, including home equity, a meaningful chunk of those households cross $1 million. Various analyses land around the 1 in 6 range. The exact percent depends on the cut, the year, and inflation adjustments. But the big picture is, a net worth millionaire household is not a unicorn in the modern United States. But now take the home out. Now take out the I'm technically a millionaire because my house doubled effect. Now take out the my wealth is locked in retirement accounts effect. The number that remains is not 1 in 6. It's closer to 1 out of a couple dozen adults. roughly 8 million people in a population of hundreds of millions. And that's why this topic matters. Because most people are chasing the wrong scoreboard. They're trying to hit a net worth milestone that can be inflated by housing appreciation, while neglecting the kind of wealth that actually changes your daily decisions. And daily decisions are the whole point. Let's talk about the biggest reason the millionaire label got so confusing. Housing did something weird over the last couple decades. A house is supposed to be shelter first, investment second. But America turned housing into a national emotion. People don't just buy a house, they buy an identity, a feeling of safety, a feeling of being a responsible adult, a badge. And that psychological package is so powerful that people will do mathematically stupid things to protect it, like buying too much house, like refusing to move for better income because we love the home, like overpaying mortgage principal while ignoring that their investable assets are tiny and their job is still the single point of failure. This is where people get trapped. They become what I call equity rich, option poor. Your balance sheet looks strong, but your life doesn't feel flexible. And you can't understand how dangerous that is until you look at a system that did it at national scale. So let me take you back to Tokyo. Late 1980s. Tokyo is buzzing. Neon, suits, money, confidence. The kind of confidence that only exists right before a crash. Land prices were rising so fast that rational sentences started sounding insane. Reuters later described prices in places like Ginza that made a single square meter worth more than a luxury car. Companies were treating real estate gains like guaranteed profits. Banks were lending against property like property could never go down. Here's the mechanism, and I want you to listen closely, because it's the same skeleton as what people do today when they count their home as wealth. Step 1. Asset prices rise. When land and stocks rise, everyone's balance sheet improves without anyone becoming more productive. You didn't work harder. You didn't create more value. You just woke up and the number got bigger. Step 2, rising assets become collateral. Banks look at those inflated asset values and say, great, you're safer now. We can lend you more. And people love that because borrowing feels like earning, but without the effort. Step 3, borrowed money chases the same assets. More loans mean more buying. More buying means higher prices. Higher prices mean more collateral. More collateral means more loans. It's a feedback loop, a self-licking ice cream cone. Now, why would banks do this? Because when it's going up, lending looks brilliant. Defaults are low. Everyone is creditworthy. The collateral value makes everybody feel protected. But here's the catch. Collateral is only valuable if it can be sold at the assumed price. And in a leveraged system, the moment prices stop rising, the logic flips. Step 4, something shifts. In Japan's case, monetary policy tightened. The cost of borrowing rose. The momentum slowed. And once the belief cracked, the whole structure lost oxygen. Step 5, asset prices fall. The Nikkei, Japan's stock index, peaked around the end of 1989 and then fell hard into the early 90s. Land values that had been treated like destiny started dropping. And once asset prices drop in a leverage system, the collateral vanishes. Now, the same loans that look safe become risky. Banks realize they're sitting on bad debt. Companies realize their wealth was a mirage. Households realize their paper gains were not a safety net. And then the human part kicks in. Panic. People try to sell, but everyone is trying to sell at the same time. Credit tightens, not because the government tells banks to tighten, but because banks get scared. Lending slows. Businesses collapse. Hiring freezes. Wages stagnate. Confidence dies. The aftermath is the kind of slow pain that doesn't make exciting movies but destroys decades of lives. Japan's lost decade wasn't a single dramatic day. It was years of people doing everything right and still feeling stuck because their wealth had been built on inflated assets and leverage, not on liquid, resilient capital. So what does this have to do with Americans being millionaires without counting their homes? Everything. Because the pattern is the same. When you count a rising house price as wealth, your brain starts making decisions as if that wealth is usable. You borrow more, you spend more confidently. You delay building liquid assets because you feel like you're already there. And if you're a bank or a lender, or even a financial media company that makes money from attention and transactions, that is a fantastic outcome. Now, don't misunderstand me. I'm not saying the United States is Japan in the 90s. I'm saying the psychological mechanism is identical, confusing asset inflation with financial power. And that confusion is what makes the millionaire account such a trap. Because it's not just about a label. It's about how the label changes your behavior. Let's come back to the numbers. But this time, let's do it like adults. If you want to know how many Americans are millionaires without counting their homes, you first have to understand why your home is the easiest way to accidentally become a millionaire on paper. The Federal Reserve Survey of Consumer Finances shows that home ownership is widespread. Around 2/3 of families owned their primary residence in 2022. It also shows retirement accounts were held by a bit over half of families. Those two categories, home equity and retirement accounts, are the two big pillars that create most mass market millionaires. Not startup exits, not day trading, not crypto, not private jets. Home equity plus retirement accounts. Now you might be thinking, okay, so what's the problem? That sounds healthy. It is healthy. Until people start treating those pillars as if they're the same as liquid wealth. They're not. And you can see that in one of the most revealing stats that gets almost no attention. The Federal Reserve data shows retirement accounts are common, but having a truly large retirement balance is rare. In 2025, Congressional Research Service analysis, based on the 2022 SCF, shows only a small fraction of households have retirement assets above $1 million. It's not normal. It's not typical. It's a thin slice. And private data backs up the same idea. Fidelity, for example, has reported that the number of 401k created millionaires is in the hundreds of thousands, not in the tens of millions. So even inside the Millionaire America story, the million is often not in the place people assume. It's in the house. And that's why excluding homes changes the entire answer. So here's the clean mental model I want you to adopt. There are 3 tiers of millionaire, and you should never let anyone mix them without calling it out. Tier 1, net worth millionaires. That includes everything: house equity, retirement accounts, business equity, and sometimes even stuff that's hard to price. This tier is large. It's where you get the 23.8 million number from sources like UBS. Tier 2, investable asset millionaires. This excludes the primary residence. It tries to capture capital that can actually be moved and invested without uprooting your life. This tier is smaller. That's where you get the roughly 8 million number from reports like Capgemini. Tier 3, liquid millionaires. This is money you can use with minimal friction and minimal life disruption. Think cash, brokerage, short-term bonds, maybe certain taxable investments. This tier is the smallest, and it's the tier that actually changes your stress level. Now you're asking yourself, Tom, why does anyone care about the bigger number then? Because the bigger number makes you feel a certain way. If the world tells you millions of people are millionaires, you feel like it's normal. You feel like you should be there. You feel behind. You feel pressure. And pressure makes people do dumb things. Pressure makes people chase returns. Pressure makes people buy speculative assets. Pressure makes people sign up for expensive products. Pressure makes people over-leverage because they want to skip steps. And that brings us to the everyday analogy that makes this impossible to unsee. Imagine you own a truck worth $40,000. You still owe $30,000 on it. So on paper, you have $10,000 of equity. Now imagine your buddy tells you, congrats, you're basically rich. You have $10,000. And you're like, okay, can I pay my mortgage with the truck? No. Can you pay for your kids' braces with the truck? Not unless you sell it. Can you sell it instantly for $40,000? Probably not. You might get lowballed. You might need time. You might have to fix something. And if you sell it, you still need transportation, which means you replace it, which means the equity wasn't really money you could spend without consequences. That is home equity, just with nicer paint and a lot more emotions. Home equity is real value, but it's not a checking account. It's not a brokerage account. It's an asset you live inside. So when someone says, I'm a millionaire, and most of that is home equity, what they really mean is, I have a valuable lifestyle asset, and I might be able to convert part of it into money if I'm willing to change my life. And that's fine, but it's a different category. The problem is that people make million-dollar decisions with that misunderstanding. They take on lifestyle obligations based on home-based net worth. They buy the bigger house because it's an investment. They buy the bigger car because we have equity. They take the expensive vacations because we're doing great. And then one job loss, one medical event, one divorce, one bad business, year later, they discover the truth. They were not wealthy, they were levered. Now, I can hear the objection forming. But Tom, my plan is to stay in the house forever. I don't need to sell it. One, okay? But then it's not money, it's shelter. And that's the point. If your wealth exists in a form you can't use without changing your life, you should not use it as emotional permission to increase your lifestyle. That's the psychological trap. And it's the exact trap that makes the millionaire statistics misleading. So who benefits from keeping that trap alive? Let's talk about the antagonist, because there is one, and it's not some cartoon villain twirling a mustache. It's a set of incentives. First, the housing ecosystem. Mortgage lenders, real estate brokers, developers, home improvement chains, even local governments that depend on property taxes, they all benefit when you treat housing like your primary wealth engine. Because if housing is your wealth engine, you will borrow more, buy bigger, upgrade more often, and accept higher monthly payments as normal because it's building equity. Second, the financial product ecosystem. When you feel wealthy, but your wealth isn't liquid, you become the perfect customer for products that promise access, leverage, or optimization. Home equity lines, cash out refinancing, debt consolidation, expensive insurance wrappers, complex investments sold as smart because you feel like you've graduated to a higher class. Third, media and influencer ecosystems. Headlines like, America has 23 million millionaires get clicks. Nuanced headlines like, America has 8 million people with 1 million in investable assets excluding their homes, and the distribution is skewed by age, geography, and retirement account restrictions do not get clicks. So the simple story wins. The emotional story wins. And the emotional story makes you compare yourself to a number that doesn't mean what you think it means. Now, how do they hide it? 3 tactics show up over and over. Tactic 1, they mix definitions without warning. They quote a net worth millionaire number, then speak as if they're talking about investable wealth. That's like counting your car's resale value and pretending it's the same as cash in your wallet. Tactic 2, they switch between individuals and households. A household millionaire is not the same as an individual millionaire. A dual income household with 2 earners and combined retirement accounts is one household but may represent 2 adults. Mixing those counts can inflate how common it feels. Tactic 3, they ignore friction. They talk about equity as if you can use it at full value instantly with no costs, no taxes, no fees, no time, no stress. In reality, selling a house is expensive and slow, and borrowing against it increases risk. And the emotional reframe you need is this: you are not a victim of these numbers. You're just operating with the wrong scoreboard. The moment you switch scoreboards, your whole strategy gets cleaner. So here's what I want you to do. And I want you to do it today, not someday. Open your financial accounts, not your budget app, your actual accounts. And calculate 3 numbers, just 3. Number 1, your investable assets, cash, brokerage, retirement accounts, bonds, anything you can convert to spending power without selling your home. Number 2, your home equity, estimated home value minus mortgage balance. Number 3, your non-mortgage liabilities, credit cards, car loans, student loans, personal loans, anything that's not tied to the house. Now, compute a ratio. investable assets divided by total net worth. If that ratio is low, you are equity rich and option poor. And if you're an ambitious guy trying to win long term, being option poor is a strategic weakness, because options are what let you survive layoffs without panic, move for higher income, start a business without desperation, buy when markets crash, say no to bad deals, and avoid being forced to sell at the worst possible time. Now you might be thinking, okay, Tom, but what do I do with that ratio? Here are 3 specific, non-basic moves that change the game, especially for men in their 30s, 40s, and early 50s who are trying to build a real million. First move, stop celebrating net worth if your investable number is weak. I'm serious. Stop doing the mental high five because Zillow says your house is up. That's not discipline. That's weather. Celebrate when your investable assets hit new highs because that's the wealth that moves with you. Second move, audit your mandatory monthly lifestyle. Take your housing payment, your car payment, your subscriptions, your insurance, your private school, whatever you have locked in. If your lifestyle requires your job to exist, you don't have financial freedom. You have a fragile arrangement. The goal is not to be cheap. The goal is to have a lifestyle that can survive a hit without forcing you to liquidate at the worst time. Third move, treat mortgage prepayment as a tactical choice, not a moral virtue. A lot of guys have this deep emotional belief that paying off the house early is automatically smart. Sometimes it is, but sometimes it's just fear wearing a suit. If you are aggressively paying extra principal while your investable assets are low, you are converting flexible money into an illiquid asset. You are buying security feelings at the cost of optionality. And if your goal is $1 million without counting the home, then overfeeding the home can literally slow you down. Now, I'm not telling you to be reckless. I'm telling you to be clear. If your investable assets are below a certain floor, the priority is building a liquid base, not polishing the house trophy. Because the first million that matters is not the one you can brag about at a barbecue. It's the one that changes how you walk into Monday morning. Let's do one quick math example to show what lazy but disciplined actually looks like without hype. If you invest $1,000 per month into a broad, low-cost index portfolio, and you earn around 8% per year over 25 years, you end up with roughly $950,000. That's not a fantasy. That's a plan. Now, add a starting base. Say you already have $100,000 invested and you keep the same $1,000 per month, same return, but for 20 years instead of 25. That gets you to around $1 million. That's the boring path. That's the path most people ignore because it doesn't make good drama. But here's what most people don't realize. This path only works cleanly if you don't sabotage it by confusing home equity with investable wealth. Because the moment you start feeling rich from home equity, you start spending like the plan is already done. And then the plan breaks. So let's land this plane and answer the question again, but with the right emotional tone. How many Americans are millionaires without counting their homes? Roughly 8 million, using the investable asset definition used by major wealth reports. And compared to the bigger net worth millionaire counts, that tells you something uncomfortable but empowering. Real deployable wealth is rarer than headlines suggest, which means if you build it, you will feel the difference in your daily life long before you feel it in your ego. And that's the whole point. Because the real prize is not to say, I'm a millionaire. The real prize is to have a balance sheet that gives you leverage over your own time. So here's your final takeaway. Stop asking, am I a millionaire? Start asking, if my income pauses for 12 months, does my life collapse? If the answer is yes, then net worth is just a number, and your strategy needs more liquidity, more flexibility, and less dependence on a house-shaped illusion. If the answer is no, then congratulations, you're playing the real game, even if nobody can see it from the outside. And if you want to know what to do next, do the 3-number exercise today. Compute your investable to total ratio and make one decision this week that increases your investable assets without increasing your lifestyle obligations. That's how you move from paper millionaire culture to actual financial power. And that, right there, is the difference between looking rich and being free.